Hello everyone, it's Professor Reiko here, continuing on with our inventory videos. This video is going to examine the difference between our periodic and perpetual inventory systems. These are just different ways to track inventory. Okay, so periodic, all right, read here, the inventory balance is determined once a period by an inventory count. Meaning when we buy inventory, we do not debit inventory. We said are going to use this purchases account. Okay, and then cost of goods sold is determined at the end of the period. Okay, and we're going to do that by subtracting the count of inventory at the end of the period from the goods available. So that goes back kind of to that formula we did in the first video as well. Perpetual, this is a running record. Okay, so this is the most common type. So it's a running record of inventory on hand with an end of period count used to correct any errors. All right, so this is the most common type. If you think about it, I mean, it now with the way technology is, I mean, if you're in Walmart and you scan a box of Fruit Loops, Walmart knows that they have one less box of Fruit Loops in their inventory. Okay, it's all automated. All right, so if the count at the end of the period is different from the records, the difference must be accounted for with the following entry, this inventory over and short. Now make sure you realize this is perpetual only. Okay, perpetual only. All right, so this inventory over and short, so this is going to adjust cost of goods sold. Okay, and it's you put it in the other income and section on the income statement. So not up with your main revenue and cost of goods sold, and then you'll adjust inventory down, or it could be vice versa, adjusting it up. All right, and this typically represents theft, anything breaks, incorrect bookkeeping, catches all that stuff. All right, so let's just look at an example where we can do them side by side. I like doing things side by side when you get the chance to because it makes it easier to compare. All right, so we've got this example here. We got a company had a beginning balance of 250 units at $5 each. Okay, so that's my beginning inventory. They then purchased another 600 units at $5 each. So that's my purchases. And then later that period, so basically if you go back to that first video, so beginning inventory plus purchases gives us goods available for sale. And then it says we sold 500, which means the difference is the number of units left over. So we could walk through and already determine what our ending inventory is going to be. So it says determine the ending inventory, prepare all journal entries under both the perpetual and periodic. All right, so let's just do perpetual. Oops, sorry, I misspelled that. Perpetual and periodic on this side. Okay, and I'm just going to draw a line as straight as possible down the middle. All right, so the first thing, all right, so we don't do a journal entry for the beginning balance, but let's not forget that beginning balance is there. We'll need to remember that in a minute. All right, so it says we purchased 600 units at $5 each. All right, so remember on the perpetual side, we're going to debit inventory. So 600 times 5 is 3,000. And we'll either have cash or accounts payable. I'm not really concerned with that. Now on this side, periodic, we debit purchases for 3,000, and then we'll still have cash or accounts payable for 3,000. All right, the next thing it says is we sold 500 units at $8 per piece. All right, so remember, this $8 is the sales price. All right, the cost is still $5. So remember, when we sell something, we got to record the sales side of it and the cost side of it together. All right, so over here, so we'll have accounts receivable or cash, depending on what was if they received cash or not. So 500 times 8 is 4,000, and that will be our sales revenue. Oops, sorry, sales revenue. Started to write it over there for 4,000. And then we would have cost of goods sold and inventory for the cost portion. So 500 units times 5 is 2,500. All right, so over here, they're going to have accounts receivable or cash for the 4,000 and the sales revenue. So that's the same. And then for this, there's no journal entry. Because remember, they're only going to do that at the end of the period. All right. So now we're to the end of the period. And so remember, the formula says We have 200 beginning inventory, 250 plus purchases. That equals goods available for sale. That's 850. Less units sold equals ending inventory of 350. Okay, so that I'm using, if you go back and watch the first video, I said that one formula I wrote out, it's kind of an important one to know because it kind of helps you kind of track things. All right, so beginning inventory plus purchases gives me how much I have available, less what I sold tells me how much is left. All right, so if you think about the inventory balance on this side, all right, we started with 1250. We added 3,000 in the first journal entry. So 1250 was the beginning inventory. I remember this all is in dollars. This up here is units. Should have been clear on that. And then we sold 2,500 worth, and so our ending inventory is 1,750. All right, so over here, there's no final journal entry that's needed. Because we're doing perpetual, so we've been tracking it all along. Now, we would have done the inventory count and trued it up using the inventory over in short, but that wasn't a part of this problem. All right, now on this side, so we still have 350 units times $5 a piece. All right, so that means my ending inventory is 1,750, which is the same as over here. You have the same ending inventory. The only difference is if I set up a T account for inventory over here, remember, we weren't adjusting inventory up and down during the period. We started the period with 1250. All right. And then what we're going to do is, well, I'm going to write the journal entry first. All right. So we're going to put inventory on the books, and I'll just call this ending inventory for 1,750. I'm going to record cost of goods sold at the end of the period, 2,500. I'm going to take my purchases account off the book, so I'm essentially closing that out, and then I'll start that back over next period. And I'm going to take my beginning inventory off the books, 1,250. All right, so if you think about that, I'm taking off the 1,250 and then adding to it the 1,750, and that gives me my 1,750 ending balance, which matches the other side. Now, you could combine the two inventories. I was just doing this to kind of show it step by step. I think your book might do it that way as well. I mean, if you wanted to net out the inventory account and basically make this, basically scratch that one and make that 500, it would still balance and be fine. And then you would have over here, you have the 1,250 beginning plus a 500. I'm not going to write all this down. You'd have 1,250 plus the 500, still giving you 1,750. So either way it works. So however your teacher wants you to present that, make sure you follow their lead because come test time, they're going to want it the way they've done it in class. All right. So this is just an example of perpetual versus periodic. Okay. So that's something to keep straight. Just remember, perpetual is a running total. Periodic, we just do it once per period at the end of the period. All right, so the next video we'll get into a few more items on the cost, and then we'll start getting into FIFO and LIFO and some of the bigger problems in this chapter. All right, so keep tuning in. We'll keep rolling through the inventory chapters, and I'll see you next time. Thanks.